Hello folks, first a quick update. We are converting this channel into an English channel. This video and further videos will be uploaded in Hindi on Assetyogi channel. So if you want to watch this video of EPF in Hindi, then you can watch on Assetyogi. You can find the link of that video in the description. Now coming to our topic, EPF or Employee Provident Fund rules have recently been changed. There is a lot of confusion regarding employee and employer contribution. This is not just a technical rule change. This will actually change your financial planning and retirement planning. So in this video, we are going to cover what will be the impact on your salary because of this EPF change, what it means for your retirement corpus, and where to redirect that gap if it opens up. Before we start, subscribe to Assetyogi Wealth channel from bottom and hit the bell icon so you never miss out our latest finance content. Now, first a quick refresh of how EPF works. See, every salaried employee has a fixed amount automatically deducted from his salary every month, and the employer adds an equal contribution. This is EPF. It currently earns 8.25% interest per annum, and this is all government backed and tax free in most cases. It is not just a retirement fund. You can also withdraw it for a medical emergency, your child's education, or even buying a home. Historically, it has worked as a forced savings habit and a financial safety net. This runs automatically without much effort on our part. Now, the question that is bothering everybody now is what has really changed and why it matters. As per old EPF rules, PF was calculated on your actual basic salary, whether it was 20,000 rupees or 1 lakh rupees. 12% was deducted from both sides, that is employee as well as employer. As per the new rule, mandatory provident fund is now capped at 12% of 15,000 rupees. Now remember this 15,000 rupees, this is called as wage ceiling. So when we say 12% of 15,000, the amount becomes 1800 rupees. So 1800 rupees from employee salary will be deducted, and on top of it, employer will also add 1800 rupees. This is the only legal requirement now. Anything above 1800 rupees is only voluntary for both employee as well as employer. Now let us understand this with an example. See, now here we are going to see different cases less than 15,000, 15,000 and more than 15,000 also of basic salary. Please understand, I am only talking about basic salary, not the complete salary, because our EPF deductions are decided on basic plus DA salary, right? So suppose if somebody has less than 15,000 of a basic salary, suppose somebody has a basic salary of 12,000 rupees, then the employee deduction will be at the rate of 12%. This is compulsory. So in this case, 12% of 12,000 will be 1440 rupees, which means 1,440 rupees will be deducted from the salary of the employee. On top of it, the employer is supposed to match the exact same amount if it is less than 15,000 rupees, which means that employer will also match the same 12% and 1,440 rupees for the employer contribution towards EPF, which means that your in-hand salary is not going to change, which means that these new rules will have no effect on you. Now, next is 15,000 rupees, which means the exact wage ceiling limit. So in this case, it will be 12% of 15,000 rupees and this amount comes to 1800 rupees, and employer will also match the same amount. This amount is also going to be 1800 rupees. Again, there will be no change in your in-hand salary, and because of these new rules, there will be no change in your deductions as well. Now the main question is all about more than 15,000 rupees of basic salary. So we have taken an example of 50,000 rupees of basic salary. So if you calculate 12% of 50,000 rupees, it comes to 6,000 rupees. Suppose the employee wants to get his EPF deduction to 12%, then it is still possible. So which means that you can still get your 6,000 rupees deducted from your salary and it will be deposited by your employer on behalf of you towards EPF contribution. At the same time, now employer is no more obliged to match this 6,000 rupees. Now, after the new rules have come, his mandatory contribution can be limited to 1800 rupees. If he wants to match your amount, which is 6,000 rupees, it is only his choice. He is not mandatorily required to submit 6,000 rupees. Anyway, see, all this is part of your negotiated CTC, which means cost to company. So even if the employer is going to deposit 6,000 rupees, as employer contribution to EPF, it is only going to come from your CTC only, right? But the question is, if most of the employers decide to only opt for this mandatory contribution 1800 rupees, that means you are going to get more in hand salary. The balance 4200 rupees is going to get added to your in hand salary. I'm not taking tax considerations for simple calculation right now. So now the question is, what do you do with this 4200 rupees? When you get more money in hand, sometimes we increase our expenses and we decrease our savings. So we have to make sure that whatever gap is there, we should invest this amount. How we should invest this amount now? We will discuss that later. Let me just cover one more example here. See, if somebody has a basic salary per month of 1 lakh rupees, then 12% of this will become 12,000 rupees. So if you are getting your 12% deducted from your EPF, then employer is still supposed to deposit only 1800 rupees as mandatory contribution. He is not required by law to match this exact 12,000 rupees amount. But at the same time, what you can also do is, if you really want more in hand, you can also decide to get your 1800 rupees deducted only towards the EPF. That is also possible if you are really looking forward to a higher in-hand salary. Now let's see the biggest drawback of these rules. See, in this example where we are taking the 1 lakh basic salary, here the EPF contribution which was supposed to happen here, let's say this was 10,200 plus 1800. In this case, there was no tax on this amount which was getting submitted to EPF. There was no tax. Now, since this 10,200 is getting added to your salary, this is taxable. So, this will become taxable, and this is the biggest drawback of this scheme. And the second drawback is obviously that we have to now do our own financial planning and retirement planning. Again, I am taking one more example, the same 50,000 rupees. Suppose, so we actually saw in our example that in-hand salary is going to increase by 4,200 rupees. So the question is, what do we do with this 4,200 rupees? So ideally, I would suggest that you should be investing this amount and not increase your expenses. Otherwise, our retirement planning and financial planning can go for a toss, right? So what are the alternative investment options that we have? See, first, we can check out NPS. In NPS, still, employer contribution, if it is there in your organization, then it is also tax-free, right? So maybe you can increase your NPS amount, or you can probably invest this amount or split this between NPS, PPF and mutual funds. PPF is still a good option if you are looking for a fixed income kind of thing which is equivalent to EPF, although the interest rate is slightly lower in PPF. It is about, I think, 7.1% or something. And in EPF, we were getting almost 8.25%, so almost 1% extra, right? But still, PPF can be a good choice as a retirement planning tool. And mutual funds also is a great retirement planning or financial planning tool. And this is where we can also help you. You can attend our next free webinar where we will discuss on how to build a smart long-term portfolio. We also share free tools and calculators in our webinars. You can register for the next free webinar, link is in the description. Now let's also look at some other changes that are there in the new EPF rules. Now withdrawal claims will also be settled within 3 days. Earlier the official window was 20 days, but in practice it often took months. Pension and EDLI insurance claims will still be settled within 20 days. Accountability has been added. If an EPFO officer delays a claim without a valid reason, 12% annual penal interest gets added to the payout and can be recovered directly from the officer's salary. Now, if you liked the video, do give a thumbs up and share with your friends and family members. I will see you in next one now.